a recession is not a bad thing per se, right? It's a correction, and our economy has to go through periods of correction so that we can continue to move on. The bad business or the businesses that aren't viable, that is what gets weeded out in corrections and recessions. And the companies that make it through are the stronger, better companies.
Hey, everybody. Thanks for joining us with another episode of the 435 podcast. We are talking money today. The markets crashed last week. Everything was in chaos, at least from the headlines. But Branden
didn't crash.
Branden Charme comes in and chats through his thoughts and what the markets actually did and what caused those things to happen. We hope you enjoy this episode, guys. We'll see you out there. I've had a couple of requests from listeners that we should talk about money more often. Okay. And after a couple of weeks ago, we had Aaron Olson on. We were talking about Bitcoin and fundamentals of money and things like that.
It's a good episode.
And then I appreciate that. Thank you. Coming from you, that does mean a lot. So it's Thursday. What's the day of the week?
It's Thursday the 8th.
August 8th. And Tuesday, we had a market shakeup where the stock market.
Well, it started last week.
I guess it started Friday.
Well, you had on the 30th, you had a pretty big. You started having sell-off in the market on the 30th, and then on the 1st, the market was quite a bit up as the Fed came out with their guidance. Market started, pricing in rate cuts, but there's two things that happened. Job reports came in unexpected, and also something that people in the U.S. don't tend to pay attention to a lot, but the Bank of Japan Central Bank, started issuing some guidance saying that they were going to raise their interest rate.
They still have they been negative interest rates for a long time? And then
they had been. They're positive now, but like in the U.S., we were hiking at one point. 75 basis points, which, by the way, so a basis point is a percentage of a percent. So 75 basis points is 0.75% or 0.75%. That's 75 basis points. Like our central bank, the Federal Reserve, had started at 25 basis point increases, 50, and they did eventually some 75 basis point increases. Japan did they haven't raised rates. I mean, it's been so low for so long. I mean, like people in the U.S. think it's crazy here. They can't even comprehend typically what the Bank of Japan's done since the 80s. They hiked at 10 basis points. That was their big. It's big like a jump. Joke. It's and so they came out and they said that they were going to do 15 and they were going to start raising rates. And that caused a large amount of volatility. So then on the 1st, you had some selling on Friday. That was quite significant. And then over the weekend, there was some real leverage unwinding that happened, and some pretty big market volatility. Markets opened up Monday morning, gap down. Actually the VIX, or the volatility index of the market, which, you can do an episode on how that is derived, but it prices your 1 standard deviation move over a 30-day change in the S&P 500 based upon the implied volatility from the options contracts.
You lost me already.
Okay, so the VIX is referred to as the volatility index on the S&P 5. It's a derivative of the S&P 500.
Okay,
but
only the 500.
Yeah, but people apply it because the S&P 500 covers so much of the broad market. They kind of apply it towards the market in general. Oh
my gosh, I'm going to sound stupid. One more step back. From my understanding, the S&P 500, the Standard & Poor's 500, it's the calculated based off of how do you make it into the 500? How does a company crack into that 500, and then how are they?
It's a great question for all the people that believe in passive investing. Standards & Poor's selects it.
There's no specific criteria.
There is not a quantitative rules-based system for how somebody gets added to or removed from the index. So generally speaking, it's 500 of the largest companies in the U.S. It actually has 500 and is it 502 or 504?
Perplexity.
different stocks in the index, right? But it's because some of those like Berkshire has Class A and Class B. So Class A and B would be in the index, thus technically having more than 500. But it covers 500 of your largest publicly traded U.S. companies.
Got it. Okay, that makes sense. But so now keep going. Volatility is based off of that index.
So the volatility index is kind of the options market will say there's a premium people will pay. In the episode that you guys did with Aaron, you talked about options and futures contracts and like making that price discovery for what they think price will be at a future date. Right. And so if you kind of couple that with understanding statistics and your regular distribution, right, probability distributions, a one standard deviation move 30 days from now, what is the market pricing that? That would be called your implied volatility, right? So that could be up or down, and that is what information builds the volatility index. So it's kind of saying like how much either up or down, typically it's down though, is the market pricing in for the the VIX would refer to the S&P 500. Okay, so on Monday morning, the VIX, the volatility index, had hit 66 as a reading.
So it's on a scale of what?
It doesn't have a scale. There's no upper bound to it. But it had been recently as low as in the 12s. Okay.
So 0 would be, it's going to be exactly the same as it is today.
The market would expect absolutely no change whatsoever within one standard deviation move over the next 30 days.
So then as the number grow, can it go negative?
No, because the market going down would still be a move, right?
Okay.
So remember, it's pricing in a move up or down in the market.
Okay.
Your historically low readings on the VIX would be like as low as like 7 or 8 would be like extremely low.
So the likelihood of the market going down is really low. Is that what you're saying?
Well, no. It's just the volatility, right? We're just having a conversation about volatility, right? Because we know markets go up and markets go down, right? They go up and down a little bit every day.
I see. Okay, I'm tracking now. I understand the volatility meaning not necessarily whether or not
it's not saying directionally.
Okay, that's where I was getting mixed up. I was thinking it was a direction, but it's not. It's just how stable.
Stability could be a different way to potentially describe it, but it would be mathematically not the most appropriate way to describe it. But
so volatility.
Yeah,
volatility. Look up the word volatility.
Okay,
got it. Write that down.
Anyways, here's the important part. Historically, lowest readings you're going to see on a VIX, 7 or 8 would be extremely low volatility. And I would have to go back and look. I don't even remember when it's been that low. 12 was already really low. You would say like 17, 18 would be like a bit more of a normal range. 66 is the third highest reading in history. That is a lot of implied volatility.
When did the volatility? So the S&P 500 goes back all the way to like the 30s, right?
Yeah, I don't remember the exact date off the top of my head.
So when you say in history, that volatility index.
Well, the VIX wasn't created until after options came out, right? So first there was futures contracts, and then options came as a derivative of the futures contracts,
right?
I guess
my question is,
I'm not a great historian. Basically, we had volatility comparable on Monday,
comparable to
2008.
Okay, got it. Which was devastating for a lot of people. But we had crashes in 2001, in the 90s. Like we've had
VIX wasn't that high. The volatility index wasn't
still
that high
was not that high in these like really dramatic moments.
Yeah.
Okay.
So I believe the other time it had gotten higher than that was 1987, the flash crash.
Okay.
Obviously the markets haven't crashed, right? But
yeah, I think today so far they're still up for the day,
up, right? So we're in there's a correction going on in the market, and there's some underlying causes to that, or speculation of the reasons. No one knows for sure, right? It's impossible there's so many participants in the market. Like you can't.
Yeah, you can't
say definitively what causes something. You can say there is this one thing that we've been able to notice, and that would at least be a factor, maybe a major factor, but you can't ever say the markets did something because of one singular thing. It's just not.
Got it. So going back to the volatility index. So it hits 66. The trigger for that,
which by the way, tripled. So that's over triple in one day.
And so my, I know money's tough for me to understand. The market is hard for me. I'm not a statistics guy, so I'm trying to.
Okay, so
this is just me being honest with. I don't know anything about when it comes to the markets. If I ever talk about it, I'm probably only half right. If at all, I'm only half right.
It's probably more accurate than I am a lot of times.
Oh, I don't believe that. I don't believe that for a second. So the volatility index, something triggers that index to change. What are those triggers?
There's no triggers to make it change. It's a calculation based upon the amount of premium people are either charging or willing to pay for options contracts.
So who are the biggest purchasers? Like, so I'm guessing there's certain institutions that are going to put that into play. And so,
no, it's not fair to say that.
Okay.
I don't think it's fair to say that. And it's because
the statistical analysis
there's too many,
of it.
No, there's too many participants.
Okay.
So you can say like, who's the biggest? But if the biggest only accounted for, 0.5%,
it's still not
like,
going to,
it's just not significant to say, oh, this is all, this one hedge fund's fault, or this is all, a result of, Lehman or Bear Stearns or something, right? It's like not, and I'm intentionally using banks that
are already gone,
obviously
already made mistakes.
But, it's not fair to say, oh, they are single-handedly, essentially like moving the market on this.
Okay. My just a quick sidebar on the number of participants in the market. So when you're talking about in the market, it's the trading of stocks and dollars, like currencies. Is it all collected into one? Because you're saying it's directly related to the S&P 500.
I don't want to sound like a philosopher here or some kind of.
That's funny. You're the second person to say that in the last week.
But like when people say like, oh, the stock market. Okay, the stock market is a definable market. It's what stocks are trading on a certain stock exchange. So you could say the stock market, and you could define the stocks that trade on the New York Stock Exchange or the stocks that trade on the NASDAQ Stock Exchange, right?
Right.
But if you just say the market, everything's in the market.
Any financial asset.
You just stopped at McDonald's and bought something. You're in the market.
Yeah, right.
Okay. You can stop and get a candy bar at Maverick. That's in the market. Or the market is like this all-encompassing everything.
Right.
Okay. It's just any economic activity in any way, shape, or form.
Financial tools and systems that are changing.
Or not.
On a moving basis.
You're still, even if you were a plumber and I was an electrician, okay, and you came to my house and did work, and I went to your house and did work, we still traded labor in a marketplace.
Right.
It's still in the market.
Right. Got
so
it.
People say, so I'll hear sometimes, well, I like real estate because it's not in the market and the market's rigged. Your home is in the market. Okay. That real estate is in the market. Right. Everything is in the market. I don't know how else to really explain that. It's a misconception. If you want to define more specifically and say who are the big players in a certain segment of the market, that's a fair conversation to try to have, and one that I'm not an expert in.
Right.
Right. I don't have the time to go and to find out who are the biggest hedge fund traders of, penny stocks or something. Right. Like,
right.
I don't.
So going back to the participants in the stock market.
Okay.
You're going to have a bunch of different exchanges. So the NASDAQ.
There's not a bunch. There's a couple, but yeah.
Well, I mean, if we think about it,
the two big ones would be the New York Stock Exchange and the NASDAQ.
Right. Those are the two big ones. Mm-hmm. But I've seen articles about other exchanges, whether it's the Japanese exchange or the Chinese exchange.
Yep. So every country has kind of their own exchange.
Does every country have one?
No.
Oh, okay.
But a lot of your more developed countries are going to have exchange.
They just have their own exchange.
London exchange.
And so there's some that are growing based off of their own individual market forces within their economy.
Well, an exchange is just where
can I have a company on on two exchanges?
Mm-hmm.
So you some of these companies will be on multiple exchanges.
Theoretically, they could.
Okay.
So it just, like just because you sell your product at Walmart, think of like Walmart is like the New York Stock Exchange, and Target is like the NASDAQ. And I don't know, maybe if somebody's dogmatic about those two things, they might flip them. But there's a bunch of products bought and sold. Okay, so people that sell products go, and if you have something for sale, you take it to Walmart, and Walmart lists it for sale there for you, and you're a consumer, you want to buy something, you go to Walmart and you buy it.
Right.
Okay. Now that's a retail setting. So it's like a company selling it. So companies wouldn't take their stock to the stock exchange when they go public, but once it's public, right? So like once you own a stock, it would be a very challenging process to sell me your stock directly, but you can sell your stock through the exchange, and I can go buy the same stock through the exchange. Cause remember, stock is fungible like cash, right? Like if you have a share and I have a share of the same company, it's the same.
Right.
Right. It's just, there's no difference between your share and my share.
Right. It's just another medium of exchange.
Yes. It's we both have a share, which is a percentage, essentially a percentage interest in the overall company.
Right.
So if you have a caveat, right, if you have like preferred stock or something like that, or different share class. But just talking common stock, it's fungible.
Okay.
Right? So you would go, sell your stock through the exchange, and I would go buy stock through the exchange. So, and where that happens is just called the stock exchange, right? And people then sometimes refer to that as the market, but you can see now we're talking about making a market, not a market isn't this tangible thing the same way. Does that?
Yeah. So what I guess what I'm trying to understand, going back to the volatility index, we see a massive. It's kind of like, in my mind, it reminds me of like an earthquake. An earthquake happens in the stock exchange, in the stock market.
So here's why the VIX and the volatility picks up. And you have to understand the way that options work, which is a very complex thing. And I want to be clear, I am not saying people should ever trade options. It's very complex and advanced instrument, right? It's but it is essentially insurance that you're buying on a stock position. Okay. So if I owned, to be clear, you can't invest directly in an index. So I'm going to talk about index as though I was. But
is there a disclaimer that you have to say?
That's the disclaimer. If I had 10 shares of XYZ, index fund, okay, and the price is currently 100, and I'm going, I think some things could change in the next 30 days or the next year or whatever this next time frame is I'm going to define. It could go down, and so I want to buy some kind of insurance that if it goes to 80, I could still sell it to somebody for 100, or I could still sell it for 95, right? So you can determine the price, and that's called a put option. Okay. So you can determine when you have the price, you can determine when you can sell it, right? And you can sell it at any point in that time if it's an American option, and the price at which you can sell it to somebody. And so the person on the other side of that trade has an obligation to buy it from you at that predetermined price.
Got it.
Okay. Now, when you have an insurance contract, what do you pay? What do you pay every month for your car insurance?
I pay
premium.
I pay it annually,
you
but
pay a premium, right? Mm-hmm. You pay a premium so that if something happens and your car is wrecked, somebody else is picking up that loss that you would have then otherwise incurred. Okay. Right. So there's a premium cost. Now, if you came to me and said, hey, I have these, shares of this thing that's worth $100 today, and I want to sell, I want to buy the right to make you buy them from me for $100 at any time in the next 30 days. You're going to make me pay you money, right? You say, okay, I'll take that liability,
but I want a premium of $10.
Give me a premium. Okay. So the fluctuation in that premium is there's more inputs, like the time, and obviously the price of everything kind of changes it. But the premium in this kind of simplified down way is the implied volatility.
So if I charge you $50 to make that bet, then
you're paying a lot of money. So you're paying $50 to sell it at 80, which means if it just stays at 100, you've lost half your money potentially, right? Just to have the right to sell it at 80. That wouldn't make sense.
So that wouldn't make sense. But what I'm saying is that like if the premium is higher, whatever this example is, but if the premium is higher, then the risk is higher because I'm offsetting for You're
expecting a bigger move, right?
Bigger move, right? So like if that premium goes up, the volatility is going up. Is that
the volatility index? That's how the volatility index is created.
So I know that was a long example,
very drawn out.
Understand that thing.
Now, what you have to understand is there's something called the put call parity. Okay, which means if I can, just like I can buy the right to make you buy my shares from me for a certain price, I can buy the right to buy shares from you at a certain price too, right? That's called a call. Okay. The implied volatility on a call and a put has to be the same, or it can create an arbitrage opportunity in the market. So the market will always look for those opportunities, and they will work. There are people out there that will work the arbitrage on that to then always bring it back in line. Okay. So why does the volatility go up when the market's typically going down? It's because when markets are going up, people tend to just buy more, right? And they're less worried about
risk.
But if the market's starting to go down and you want to start buying insurance from loss, now it's very advantageous. People, right, run in to buy the insurance. And so now everyone's buying it. There's this big demand and there's this move happening. So the market makers price in more implied volatility and people pay for the implied volatility. And so all of a sudden the volatility index spikes.
Got it.
Okay.
So this spike happens. And then on Friday,
well, it started to pick up late last week, but the big spike happened Monday morning,
and the market was down a massive amount in a single day. And I think a lot of people were like, what is happening?
When I got to the office Monday morning, the futures market was almost 7% down.
7%. From a historical perspective, that lines up with what other time?
Down 2022.
Okay.
I've seen in my career the market be down 7% a day. It's not unheard of. It's just not fun. It's not fun. And the market did recover from that. It by the time the market opened, it was already kind of buying back. And you have to really understand the complexity of the way that all the other countries in the world trade U.S. instruments. Right? Remember, we are the
reserve currency.
We're the reserve currency. We also have some of the best assets, the best companies, and so people like to invest here through the entire world. Right?
There's stability in that success that we've had over long tail.
Yeah, and so our exchanges in the U.S. are open. So here in Utah, our trading hours, it's all based on New York time, but it's 7:30 in the morning till 2 p.m. Right, so it's 9:30 to 4 p.m. Eastern. And in the U.S., people tend to just think like, well, the market's closed. Well, yeah, right as everyone else gets to work because they're waking up on the other side of the world, and so there's this chain where all these different markets open and are trading throughout their workday in different time zones on the other side of the world, right? And then it kind of works all the way back to the U.S. Well, they're all trading instruments that have an effect on our market here in the U.S. And so that's why in this last example, what happened this last weekend, there's a lot of trading going on in Japan, and that spilled over, early into what would have been our futures market opening up earlier, and then our actual trading hours opening up.
So, thinking about this like butterfly effect, if you will, of what causes these big fluctuations, I think there's always a running thought, or at least from my perspective on media or looking at news articles, there's this like fear tactic of when something like this happens, I'll hear the words, and I've heard this multiple times already, is the recession has already begun, or we're now officially in the recession.
Okay.
And they've been talking about us being in a recession since 2021, right? So it's like 6 months into 2020. Am I tracking right, or is that not what you read or hear?
Yeah,
maybe this is just me.
Yeah, I think people have been calling for a recession since late 21. I wrongly was originally in that camp when they started raising rates. I thought the effect of that was going to manifest itself quicker, and obviously since changed, right? You get smarter all the time, hopefully. But what's your point? I mean,
so my question is, when we see these big trigger events, you were discussing with me about the Japanese market and how that was a big factor in what happened this last weekend.
Well, yeah, but that's very much disconnected, though. That's largely disconnected from recession.
Right. So what I'm saying is that, like, you see these big swings in the stock market, and then now you see these, they're using that thing that happened and then extrapolating that and trying to connect it to a recession. So people, when they get up and they don't understand financial markets, they don't look at it every day. They see stock market loses, a ton of money, and now we're headed into a recession, and they like connect these two things together. So what I'm trying to understand is, how can we look at some of these events that happen in the stock market and keep them separate from this other political narrative that tends to be tagged along the way? Because there's markets like Japan that are impacting this that doesn't necessarily correlate with our individual.
But there's sometimes there's a difference between correlation and causation, though, and sometimes you can have causation without correlation,
of course,
per se, and vice versa. The first thing everyone needs to understand is just an individual is a recession is not a bad thing per se, right? It's a correction, and our economy has to go through periods of correction so that we can continue to move on, right? The bad business or the businesses that aren't viable, that is what gets weeded out in corrections and recessions. And the companies that make it through are the stronger, better companies. And that's what
pushes us to new highs.
The allocation of assets and resources in our economy and in our market is what, keeps everything going, right? If you just prop up a bad company like they do in socialist companies, and the government's just funding and paying for it, right? Those economies don't grow. It's a bad business model that's not being there's either it's a bad business or they don't have good stewards of the business, whatever, right? So the question to ask yourself if you're going into recession is, hey, it doesn't really matter what the economy's doing. What's my personal economy doing, right? Is my job stable? Is my life stable? What are my opportunities? What does my financial situation look like? Because a recession could just actually turn out to be a ton of really good opportunity for somebody, right? And it's not to make light, like people have hard times in recessions, right? And if you work for one of those companies that has to go through layoffs because they have to get better and tighten up the business, like that is really unfortunate for people. And, but if you're prepared and you're managing your own personal economy correctly, it can be an area of opportunity. Certainly it doesn't have to be an area of fear, right?
So I guess when I hear you say that, though, like as a personal economy goes, for a lot of people out there, they might not necessarily have a retirement of broad, diversified retirement plan, right? A lot of people just go get on Robinhood. A lot of, especially younger kids, right? Like if you're like under 35 years old, you likely have a Robinhood account or something like that, and you might have several $1,000s in it, if not more.
Okay.
And so when they see stock market swings like this, that's where that fear potentially sets in. We were talking a little bit before about how when you go through market swings like this, you hear from clients, and you tend to hear a lot of fear out of those individual clients in their own personal economy because of what's happening in the stock market.
So I had, I have 89 households I help, and most of them are primarily here in Southern Utah. One person texted me over the weekend and just said, "Hey, do we have a game plan? Are you kind of?" And I said, "Yep, I'm aware of what's going on and I'm watching." He said, "Okay, great, that's it." And I had one other client that texted me at like 6:30 in the morning on Monday and said, "Well, these are the days I would pay you the big bucks." Right. So it was more of a commentary, just like, And,
I'm glad I have you, Branden, right? The kind of thing.
And then other than that, I made a handful of proactive phone calls on Monday. And that there's a delicacy to that, because if somebody's long-term minded and they're younger, this is not a big deal. It's not. It's part of the market, right? So I tell people, like, it's not a bug, it's a feature. This is normal, and stay the course, and you get through it, right? But if you have somebody that like I have clients that just retired last year, and these things is maybe not the first time they've ever experienced volatility as an investor, but all of a sudden it's the first time they've experienced volatility in a significant way as somebody that doesn't work anymore.
Yeah, it's not actively generating income.
Yeah. And so I proactively called some of those clients and just talked through and reminded of their financial plans and the assets and how we had designed their planning and helped remind them of what we had put in place. So they, universally, all of them basically said, great. Yeah. Hey, yeah. We saw something on the news. We're, a little bit nervous. It's kind of scary out there, but really appreciate that we have you, appreciate you called, and, we feel much better. Thanks.
Yeah.
So you want to not cause alarm and concern where it doesn't need to be raised. But if you kind of know it's there with certain clients or something, it's better to be proactive, in my opinion, and try and reach out and just coach them through it proactively. You got to think there's a difference between a recession in the country, a recession in your life, and then what the market is doing is oftentimes largely independent of that. Especially if your economy is okay, what the market's doing is potentially just providing you opportunity, not taking from you.
Right. And so I appreciate that. I think that makes a lot of sense. This is taking us in a different direction. Anything else you want to kind of say on that those ends we've gone through so far? I hope I didn't get people off track early on, but I really, some of these things are complex. And so understanding some of those fundamentals, it's helpful for me to learn. So just that conversation alone is just help me understand that I could obviously go and get on, ChatGPT or somebody to help me to understand that thing. But having you here explain it's helpful. So,
yeah, I think you can't actually get on ChatGPT and get the right answers here. And that's because one of the things I liked in Chantry Abbott's episode on the podcast here was he said, look, financial advice is very individualized. It's very unique. It's very specific to someone's own circumstances. And ChatGPT doesn't know you, your circumstances, your history, your behavioral tendencies, your goals.
But just understanding underlying concepts, right? Just like volatility index. Help me understand the volatility. Yeah, sure. What is it? And then how do I apply it to it? Yeah. But transitioning, we were talking about the Chantry episode. It was the Q2 real estate market update that we did. We had Chantry Abbott with Guild Mortgage. And we talked specifically about housing market. And then towards the end, we started talking about interest rates a little bit. Right.
Okay.
And in what seems to me a correlation, the mortgage rates on Monday specifically dropped. And at the longest drop was about 1 full point, 1 percentage point in mortgage rates.
Okay.
And now we've bounced up a little bit. But if we go back to October of 23, we were above 8%. Now, this is an index of lots of different mortgages because, again, back to the exact example you gave, everybody's financial picture is unique. So your interest rate is going to be different than your neighbor's because your set of circumstances are different than your neighbor's. Sure. So at the peak of this index, we were over 8% back in October 23.
8.03.
And then now we've reached basically the low point of the last 18 months, and we're just over 6.5. I mean, we're probably like 6.63 is what we have right now. So we had a big drop off right out of the gate. Why it seems to me like there is correlation, but it's not causal. So maybe can you help me understand the connections of what happened in the stock market and what's going on with
No, I think there is a lot of correlation and causation there.
Okay.
And it's kind of a complex web, so everyone's got to try to stay with me here.
I'll stop you if I get confused.
Okay. What's called the yield curve or interest rates in general, it all starts with the Fed and the U.S. Treasuries. It's generally referred to as risk-free rates because, the government can't default on its debt. I mean, they can, but there's a law that says they can't. So, there's a law that says they can't, but you're borrowing money from them that they can create themselves. So, realistically, they're not going to default. They'd probably just print more money and give you worthless money. Mm-hmm. But you have the Fed controls, the Federal Reserve, through the overnight lending facilities, controls the short end of the yield curve, right? The overnight rate. And that's when they say the Fed's raising rates. Mm-hmm. That's what they're talking about.
Right. That makes sense.
Now, kind of based upon that, you have the U.S. Treasury goes and issues, bills, notes, and bonds into the market, right? Remember, back to the market. So there's, mm-hmm. Willing private, hopefully mostly private participants buying this debt that the U.S. government is issuing, right? And they go and say, well, based on our expectations of inflation over time and risk and needing a return, we kind of demand this sort of yields. So there's actually auctions that happen. And if the Fed is giving you, think about it like this, if the Fed's giving you 5% right now to borrow you money that if you need it back, you'll be paid back in 14 days, right? 5%. Or you can say, I'll buy this U.S. Treasury note. I'll get paid back, but in 30 years, and I'm only going to get 3.5% along the way, right? Mm-hmm. It's more advantageous for a lot of people to just borrow that unless they felt, well, over 30 years, like inflation is going to be zero. So I'll lock in this, 3% real return for 30 years. That's a good deal, Yeah. So different investors have different objectives. But what ends up happening is right now we have this inverted yield curve. So the longer term treasuries are lower interest rates than
short term.
And then short term. And people think that the Fed changing rates is going to change the long end of the curve. It's not. Now that's where you start having a debate between causation and correlation. Because remember, what's determined on the long end is the participants in the market and what they're trading those bonds at.
So the long end would start where, 10-year? Or is it the 30? Like what would be the long?
It's fair to maybe start what you call the long end of the curve at 10 years.
Okay.
But you have issuance at so anything under a year less would be a treasury bill. Mm-hmm. And then a year to 10 years would be called a note. Mm-hmm. And then anything beyond 10 is a bond.
Got it.
The two most common time frames to look at is 10 years and 30 years when you're talking about the longer end of the curve, right? A little bit of subjective on kind of where you're talking. But the idea being is that now those interest rates are set by people trading bonds in the market, right? So it's not set by government. It's set by the market and what people are willing to buy and sell those bonds for and the yield that they require in buying and selling. Okay. Think about that. And then what I'm going to add on top of that is now the mortgage rate. So even though it's a 30-year mortgage rate, now there's a correlation to the 10-year treasury. Mm-hmm. And my speculation here is that it's really priced off the 10-year treasury because banks don't anticipate people are going to keep a mortgage for 30 years, actually, right?
Yeah, I think the average homeowner has a house between 5 and 7 years across the country. Right. I think NAR data is that the average home is held for 5 to 7 years.
And so mortgage rates are going to look at the 10-year treasury and give what's called a credit premium or a credit spread. So when you get a mortgage, typically you're really getting, the 10-year treasury rate plus maybe, anywhere from 2 to 3.5%. Mm-hmm. So you could have no fluctuation in the 10-year treasury, right? The yield curve there, but you could have a fluctuation in credit spreads across the market when you start looking at different credit qualities. And so mortgage rates could go up or down actually just based on that. Mm-hmm. It's going to be slightly.
That makes sense.
Typically you're going to have more move in that, either wider or narrower when the underlying 10-year treasury is also moving. But all else being equal, the credit spread could sort of stay the same and the 10-year treasury could go down 1 and mortgage rates would come down 1.
Got it.
Right. And there's a pretty high correlation to that. It's an average of about 0.8. going back to the inception of the 30-year mortgage index.
So real quick, let me slow you down a little bit. So you're saying that you think this index, like if I was to take this mortgage index and I was to compare it to a 10-year bond, like the 10-year treasury
note, yep,
they would be pretty similar. Is that what you're saying?
You're going to be pretty similar plus the credit spread. So
plus based off the qualification of the buyer of the purchase getting the mortgage. So is that what you're meaning by adding the credit spread in there?
Yes and no.
Sorry.
So
man.
Not to complicate it further, but the market, remember that when you go get a mortgage and I go get a mortgage, there's a decent chance our mortgages end up in the same securitized mortgage-backed security that now has thousands and thousands of mortgages in it that then people can buy different tranches of to artificially change essentially the credit quality that you're buying as the investor on the back end of all this. But a credit spread is generally looked at as the market, as if you have a risk asset, right? So something that is likely a higher likelihood of there being a default, right? Mm-hmm. Versus a treasury, which has no real default risk. Okay. You're going to ask for a premium over that.
Right.
Right. So you're going to say, well, I'm not, if I can borrow the US government,
it's volatility. It's factoring in the volatility.
It's factoring in the risk. If you can borrow money to the government for 4%, why would I borrow you money for 4%? You can't print money to pay me back.
Right.
You could default. So I'm going to start asking for a little bit more. Right. So so if economic conditions are good and we're really hopeful, or there's a lot of demand and there's not a lot of supply, right? You could see, well, maybe I'll borrow to the government for 4, but I would maybe borrow to somebody buying a home at, 5, only a 1% credit premium, mm-hmm. or 2%. But if things are looking really uncertain, maybe I might be asking for 3.5. Mm-hmm. Okay. Now, historically, if it gets beyond 3.5, that really freezes up the economy, typically in a pretty big way, and causes some significant issues. So those credit spreads have somewhat of an upper bound. They also have somewhat of a lower bound because, like I said, if you can default, the U.S. government can't. Why would I borrow you money the same rate?
Exactly. That makes sense.
Okay. So now remember, there's a correlation there, and credit spreads
compared to the treasury
can play an impact. Okay. Now you have to fast forward to what happens when there is large levels of uncertainty going on in the world and in marketplaces.
Okay.
So people sometimes say the words flight to safety. Mm-hmm. Okay. So people will sell their risk assets to buy something more secure, right? And that's why sometimes, like if you talk about gold, people say, oh, flight to safety in gold, because gold always has, gold's always going to have this intrinsic value. Now, I can go for an hour on why I have, issues with that. It's a good theory. It's kind of, it's supported by history. But in history, in the Roman Empire, they couldn't even conceptualize sending a spaceship to outer space to mine gold from asteroids, which Intergalactic here in St. George is literally working on the technology to do that. So right. If all of a sudden they start mining asteroids for gold, your gold's all of a sudden maybe not be as scarce as you.
But that's just assuming that the people that get the gold are going to put that gold into the marketplace, because they could just hold on to it.
They could just hold on to it, but then if everyone just holds on to gold, what is it really worth anyways? People have to want it.
Another great point.
People also have to want it. So gold actually has a lot of volatility.
But they're safety assets. In general, the flight to safety is generally.
Yeah. And I don't believe in the flight to safety. I guess what I'm saying is I don't really believe in the flight to safety. What I believe in and what I think actually happens is the flight to quality.
Okay. Good money drives out bad, I've heard. So
yeah. So, the theory being if I have money invested in the stock market and I want to be a long-term investor, and this is totally just a hypothetical, I'm not endorsing any of these, but if you have, if you're trying to invest in, consumer products or whatever, right? And you have a startup of an energy drink company and we're going into a recession or something. It's like, or there's volatility expectations in the market, or there's a lot of uncertainty. Do I want that little tiny company that is unknown if they could weather the storm?
Yeah. Based around a brand,
or do I want to own like
some
Coke or Pepsi?
Right.
You know what I mean? Like,
tried and true.
is there more stability and quality in that I would have more faith in that as an investment over the coming horizon,
Right.
that I have a better shot, right? So I'm potentially willing to give up. I had a thesis that this was going to be some big growth company. I was going to get this huge return, but now I'm, a little bit, I'm getting shaken out of my position because there's all this uncertainty in the world for whatever reason, whether it's geopolitical, international tensions, regulatory environments changing,
Shipping containers get stuck in the Panama Canal.
weather, you know what I mean?
Right. Yeah.
There's all kinds of stuff. But I'm going to change to quality, right? So I think it's not a flight to safety; it's a flight to quality.
Okay.
Now you have to unpack the next layer down in unraveling this entire mystery about the mortgage rates and what's going on is the Japanese yen carry trade, which I bring up running the risk of other people on the internet pointing their finger at me saying, everyone's talking about this right now. Of course you know about it, and everyone's just talking about it.
You also talked about it back in April.
I talked about it in April, and I did on my own podcast. I did an episode with a friend of mine that we tried to break it down for just kind of average person. Like, what is this whole thing?
Yeah, listening to that episode, that's where I'm like, it was helpful in listening to that moving into this.
In essence, from a 30,000 foot view, go listen to it.
We'll put it in the description.
Yeah, link it in the description.
Michael
Guyett is his name. He's a CFA, well respected, really smart guy. Actually has an award-winning paper on using the relative strength of gold to lumber as a leading indicator for economic conditions, because when lumber is stronger than gold, it's actually a derivative of the housing market being strong. And so people are buying lumber and it's pushing the lumber is outperforming gold. Well, when housing starts to slow down or stop, the lumber weakens and then there starts to be this flight to quality that happens. And so people start buying gold, right? So it's this leading indicator that he developed. Smart guy. Anyways, 30,000 foot view, Japanese yen carry trade. You could go borrow money in Japan. Theoretically, this is, and by the way, I'll say, like, this is a very complex trade to kind of put on. This isn't, Joey and Mom's basement trading on Robinhood, putting on a carry trade, right?
Yeah, these are institutions.
When you hear about like Robert Kiyosaki, I've seen videos where he says like, oh, you borrow money in the US, you're stupid. I borrow my money in Japan. They pay me to borrow the money from Japan. And he was right at the time. Likely, I mean, I suppose I don't know everything, but likely right. If in Japan, their interest rate was 0 to borrow money, you can go get essentially.
And at one point it was negative. So they were paying you to do it, right?
By the time you borrow it from the, someone, you can't borrow money from like the Japanese government, and that's like their Fed rate. So just like you can't go borrow money from the Fed, you got to go get it from like, I don't know, JP Morgan or someone, you know what I mean?
Another
like
institution. Yeah.
There's going to be a markup, right, for them servicing all of that. So you probably pay a very small and minimal interest rate in Japan. And then you convert those Japanese yen to US dollar, and you go buy some kind of asset in US dollar that's going to appreciate. So a very lower risk idea would be to buy like U.S. Treasuries, right? And the Federal Reserve has been paying 5.5%.
So you take your yen and you'd buy Treasuries.
Yeah, you borrow yen at 50 basis points, and you convert it to U.S. dollars, and you buy U.S. Treasuries, making 5.5%. Pretty sweet, right? It's like there's nothing. You don't even have to bank on a company's earnings or growth or something, right? It's just,
isn't there an exchange rate between the two though? So there's a percentage there that's,
and because the Japanese government was keeping their interest rate low, their currency kept devaluing against the US dollar that was strengthening compared to all other markets, essentially, or at least major markets, because the Fed had raised interest rates. So because you could have your money in dollars and get this high interest rate, people wanted more dollars. Well, that pushes the value of the dollar up relative to other currencies. If you get a low return in a currency, that's going to devalue the currency. Mm-hmm. So you could not only make in this case, or this scenario, let's say a 5%, kind of just by, click here, click there, boom, make 5% on, however much the bank was going to let you borrow.
Right.
You could,
with almost no risk.
As the yen, no, there's risk. And let me explain it to you. Here's the risk. you get an extra return over the 5%. So you would get the 5% if neither currencies moved. Okay. But as the Japanese yen would come down and the dollar would go up, when you have to sell your dollars to convert, you sell your treasuries back to dollars and you convert the dollars back to yen.
Pay it back.
Okay. So if you borrowed 100 yen and you got $200, right? Or you got $100 for 200 yen is probably would be. Anyways, let's keep it simple. Let's keep it really simple. You got 100 yen and you convert it to $100. Okay. Right. And you're making this return in dollars. Okay. So now your account's going, you're like, at the end of 1 year, you're at $105. Let's call it. Okay. But let's say the Japanese yen has fallen to 80 and the dollar has appreciated relative. Okay. So because the dollar appreciates or the yen devalues either direction, all of a sudden you can take $80 and close out that position. So now you didn't make $5, you made $25.
Right.
Okay. So you just 5x your return over the original trade because of the change in currencies. Okay.
And you put a lot of zeros at the end of that.
Yeah. You leverage it up, in the futures market or whatever. And all of a sudden, boom, you can really make some money. But here's the thing is what happens if the yen starts going up in price? What happens if the yen costs $105 to close out and pay that bank off in Japan? All that money you just made, you gave it all back. You made no money. And what happens if the yen relative goes to 110?
Right.
Now you got to go borrow more US dollars from someone else to just close out the position. Okay. So what happens? So what was making the yen weak? Well, their interest rate was low and they weren't intending on raising rates, and the US has been raising rates. And so it's made the dollar really strong compared to the yen. Okay. And so there was this mass of people that were borrowing yen, converting it to dollars, and buying US assets. And I will say, before everyone blames the hedge funds, that is actually culturally a very common thing to do as an average person in Japan, is convert your Japanese savings, your savings in yen, to US dollar and buy US assets. So regular people in Japan
wonder, there's a million questions I have around why that is because cultural thing, but
it is very akin to the same reason why people in the US are converting their US dollars to Bitcoin.
Interesting. Okay. That's an interesting thought. Let's keep going though.
Okay. So
it's not hedge funds. There's individuals. There's lots of different.
Yeah, don't get me wrong. There's a bunch of hedge funds that do this. I'm sure of it. Right.
Okay. So I will blame the hedge funds. I'm going to go back to.
But don't. It's not like
a singular.
It's not like the evil hedge funds have done this or something. Right. It's more complex than that.
They are evil.
But all of a sudden you have a change in dynamic where all of a sudden at one time Japan came out and said they were going to raise rates. Well, that strengthens currencies when interest rates are paying more in that currency. And at almost the exact same time, the Fed came out and said, there's some weak economic data here. We're going to probably be lowering interest rates. And what happens?
Switches.
Dollars come down, yens go up. It switches. And so what do you have to do if you owe somebody yens and you only owe dollars?
And their timeline of when they've negotiated.
It doesn't matter about the timelines. It's you owe yen. And
you don't owe that until it's due, right?
So that you're getting into the complexities of potentially how some individual may have it structured, but generally speaking, when you start doing this, there's going to be some parameters on the bank. Just like when you're buying real estate, the bank says, "Yeah, I'll borrow you money at a certain loan to value," right? But especially like in the commercial world, like if your building drops enough, we're not refinancing. You got to put more money in. Okay. So all of a sudden, if you're looking at potentially losing a ton of money, what do? You try to close out your position. Okay. So now what do you have to do? You have to, in order to pay off your yen debt over here, you have to sell your asset that you have in the US to get dollars to then convert back to the yen to pay it off.
Right. Okay.
So that's the unwind. That's sort of the large speculation is that's the biggest component of what's caused this unwind. So all those other things happened, right? They kind of all lined up. Some light economic data, the Fed saying they might raising, lower interest rates, Japan saying they're going to raise interest rates, kind of all culminated. And everyone said, oh, holy crap, we could lose a ton of money that we've made. Let's go and just sell right away, close out these positions and de-risk. And then what happens is as soon as the first person really starts doing this, that's probably a little bit hyperbolic. As soon as people in general have to start doing this, what it creates is margin calls. And so now if someone said, well, we're going to get out now, and now it's created a loss, and now you're assets, not only is the yen getting stronger relative to the dollar, but the assets that you own are also now selling off. Now you definitely have to start unwinding. And so as one person gets their margin call, then the next person gets their margin call, then the next person gets their margin call, and they're all forced to sell. Well, if everyone's getting forced to sell at the same time, Rob, what happens? There's a lot of supply and not a lot of demand.
Right. Prices come down.
Prices come down. So that's sort of what's happened. And at a certain point, you just have enough people that will pull money off the sidelines and say, well, hey, it's cheap enough. I'm a buyer here. Right. Yeah. And that's where the support
come back up.
Yeah. The support kind of comes back into the market. And that's what keeps things from going to zero. It's like, come on, the U.S. market as a whole is not going to zero.
So those market calls. So then you have the mortgage rates go down.
Okay. So what ends up happening?
You have the margin calls.
Yeah. Let's bring this full circle back to the mortgage rates. So if stocks and equities are coming down, there's a ton of uncertainty, and the Fed's going to be lowering interest rates. Where's my quality I can look for? Long-term treasuries, man. Right? I can lock in
stuff.
Yeah, I can lock in at a 10-year, and if the Fed does lower rates, I'll actually, hopefully, I'll end up making money on this bond beyond the yield. I'll actually, appreciate in value. And if nothing else happens, I could wait out a storm for 10 years, and I know what I'm going to get paid, and the U.S. government's going to make me whole, and right, it's good quality, and so now you look at so now we get back to the 10-year T-note. Well, if there's 3 people that want to buy it and 1 person selling, what happens?
Multiple offer situations, or there's a bidding war.
Yeah. So the price of the bond goes up, which means the yield goes down. Okay. Bond prices and yields. So interest rate, a yield would be like the interest rate on the bond is inversely correlated to the price of the bond. So if more people want to buy the bond, the interest rate that you would receive, right, which is your yield, goes down. Okay. So when there's this flight to quality, because all this stuff is unwinding and there's all this uncertainty in the world, and Trump and Kamala and who knows what's happening there, and the Tax Cuts and Jobs Act getting renewed, and tax policy, and Hezbollah and Iran are launching missiles, and oh my God, we're gonna have World War III, and
London's burning down in riots.
London's burning down, and the U.S. is going into a recession, and all like
doom and gloom,
flight to quality by so big institutions or whatever buy 10-year treasury, pushes price down. Well, what happens to mortgage rates? 10-year treasury comes down. What happens to mortgage rates?
They start to come down.
They come down. There's a correlation there.
And then
a strong correlation.
And then they bounce back, right?
Yeah,
just like so there's windows of time. There's
windows of time. And what you won't typically see is because remember there's 2 moving components. There's the 10-year treasury and then the credit spread. Mm-hmm. So if you see the 10-year treasury go down in yield 50 basis points, you may or may not see the mortgage rate move down exactly 50. You could see it go down 25 basis points, which would widen the credit spread. Mm-hmm. Or you could see it come down 75 basis points, which would tighten the credit spread, right? And that's just all based on everyone's, whatever their risk calculations or forecasts are. But that's why it's not a perfect one-to-one. But if the 10-year treasuries come down because of a flight to quality, mortgage rates are probably coming down just as through correlations.
Yeah.
But that doesn't mean that, so if the volatility in the market settles, right. And, I hate to break this to a lot of people, but the market probably doesn't really care who wins, Trump or Kamala, right? Generally speaking, they just want to know so they know what they're working with.
Yeah.
And that alone probably settles a lot of volatility as you see that emerge. And then there's going to be, the flight to quality is going to be looking to redeploy back to risk assets. Mm-hmm. Well, when that happens, the yield's going to go up because now if you have 3 buyers and, 3 sellers and 1 buyer, what happens? Mm-hmm. Price goes down and now the yield goes up. Well, It pushes interest rates back up. So we say all this to, I think the idea of this is, if you were looking at buying a house this week, it's probably a decent time to lock in your interest rate.
Yeah, I think so too.
Not to say it couldn't get lower next week or something, but we're not looking too bad right now. If you are trying to get an interest rate.
Right.
Right.
if it makes sense for you to buy, if you're in the market, generally speaking, probably gets more serious sooner than later because we're in a good, we know what we have. We don't know what we're having in the future. And right now is better than it was definitely a year ago.
Yeah. And people have to understand that we are in a different world than we were a couple years ago. The bond market moves in huge, long cycles. And I am quite confident that we are not going back to 3 and 4% interest rates on mortgages. Okay. I think you are more likely in the next 10 years to see an interest rate starting with 8 and 9 than you are to see an interest rate that starts with 4 and 5. So, you know, we are in a commodity super cycle. Okay. So watch for commodity prices to continue to go higher.
In swings, right?
In swings, there's a lot of volatility in commodities in and of themselves, but watch for, this is an inflationary cycle we're in. Do not kid yourself that the Fed has just killed inflation.
Soft landing.
And they're going to soft landing it. I am more prescribed to the no landing idea.
Keep it in the air.
The Fed's going to, if they lower interest rates to a neutral rate of say like 3, that still keeps a 10-year treasury at 4, which is like where it's at now.
Mm-hmm.
So where are mortgage rates really going? Mm-hmm. How much lower can they really go?
Mm-hmm. That's a good point.
You know, but if inflation picks back up, I'll tell you which way they definitely can go.
Yeah.
And that's up.
Is that higher?
Yeah.
And so, and there's a lot of factors that go into that. So I think for now, this is helpful. I do want to continue to do money episodes and conversations. Anything you want to leave everybody with as far as, you know, what we've been talking about?
I don't know. I mean, I'm always open to talking to people.
Yeah.
I like talking.
Yeah.
I like researching. I like talking.
I know that. I know that. You're very good at it. You're good at both those things. So
listen, don't let market volatility scare you. There is a bigger game here to play. And if you don't want to play the game, you're just going to lose because you're going to play the game either way. Okay. And that's a game of, dealing with money in this country and in life. Okay. Mm-hmm. And, the beauty of America is that everyone has a shot at becoming financially well off, right? And working towards their goals and their objectives, and all those things look different for everyone. But if you want to poo-poo on the sidelines that the government's corrupt, or you know the Fed just prints money, or XYZ, that's just you're whining and complaining. You're kidding yourself and damaging yourself, even if all of those things are true. I'm not going to disagree with anyone pretty much on any of those. Mm-hmm. I mean, I generally speaking think the government is largely corrupt at worst, wildly ignorant and irresponsible at best. I think the Fed does print money. They will continue to print money, and we will have more inflation in the future. Mm-hmm. They have a 2% inflationary target. So
I think they moved off that too, didn't they? Didn't they start talking about how that's maybe not?
That will cause, when they move off that 2%, if they ever do that, that will cause a lot of volatility. I will tell you right now that would be big. But I mean, more or less, I think they have. Yeah. They just haven't said it officially. Yeah, like we all get screwed by not doing the right thing. Mm-hmm. If you sit idle, you are likely to, you know, lose the game, right? The game. But if you can identify what your values and your goals are and what you want to accomplish and what you feel comfortable doing, you can look for opportunities that work for you. Okay. And everyone's different. But looking at something from the outside and saying, well, I don't agree with, the markets are rigged because of the big banks or something. So I'm gonna not invest my money ever.
Well, yeah, there's a fine line.
You're losing out.
There's a fine line between not playing the game and being in the game but sitting on the sidelines, right? So it's like somebody to be in the crowd watching it happen.
You're playing either way, dude.
You're in the game. We have to assume that you're in the game. So you're either going to lose the game or win the game of life, and as far as financial terms go, money. Right.
So don't let all these, don't let volatility in the market. Don't let geopolitical, uncertainties. Don't let headlines and all this stuff shake you away from having a good strategy for yourself. Right?
That's a good point.
Build a plan, have a strategy, find out what you're comfortable with, find out what opportunities are available to you, and then run the ball down the field. You can do it. People can do it.
You can do it, people.
Okay. But if you sit on the sidelines and say, I'm not getting in the game because it's stupid, you lose the game, right? The other team's going to dunk on you the whole time. And guess what? That is not fun
for anybody.
You will still be, anyways.
Okay.
That's my rant. I'll get off my soapbox now.
Thank you. I think this is a good episode. This is helpful for me. I'm excited to have you continue to do this for us as we go through this fun world of financial madness.
If somebody out there actually wants me to come back on and talk about this stuff more, get in the comments and let me know, because
You don't think anybody cares?
I don't know how much people care about this stuff, truthfully.
Well, maybe 5 people listen to it. It's helpful for those 5 people.
Yeah, and I'm happy to have those conversations. I'm happy to do it.
If I'm interested in it and you're interested in it, somebody else is interested in it. Whether they find us and talking about it, that's a totally different story. But at the end of the day, This is good content. This is good information. This is helpful to help people understand if they're just looking at a sound bite or a headline.
Well, sound bites suck. So, Blueform can cut this into a real sound bites suck.
They probably will.
Lack context.
They're going to cut that one.
And the context is entirely what matters to your own personal decisions when you make decisions for yourself, especially financially. It's the context that counts.
Agreed. All right, man. This is a good episode. Hope you guys enjoyed that. We'll see you out there.
Boom. Later.
If you enjoyed this episode, please like and subscribe. Make sure you're following us on all the social media websites. We love your support. We love the dialogue. We want to continue that going.
Find us at realestate435.com. We'd love to help you find a house here in town or help you get wherever you're going.